First, thank you, Turan, very much for this opportunity to talk to our aspiring doctoral students. So my name is Peng. I'm a professor at Baruch College, City University of New York. So the plan for my talk today is first I will give you some introduction of my current research agenda on the effect of social networks in financial markets. And then I will leave about 5 minutes or so to give you some additional tips on how to navigate the job market and the exposed career. Okay, so first, social networks and financial markets. Okay, so the motivation of my current research is that while the traditional classical models have most of them have assumed that in the financial markets, the information processing is an individualized process. So basically, the only way when individual market participants sort of learn from others is through impersonal settings, such as they learn others' information through prices, through the trading quantities observed in the market. Okay. So, however, there's been growing evidence that the direct social interactions between investors actually are important in affecting the economic outcomes. So here I quote one line from Shiller's very influential book in '89, Market Volatility. Essentially, he's saying that while social interactions are important because they influence how people interpret and act upon news. So quote, unquote, investing is a social activity. Investors spend a substantial amount of time discussing investments, reading about investments, or gossiping about others' success or failures in investing. Okay, so there's been a lot of evidence in the last 20 years or so that have documented that, for example, social interactions are very important on the investment decisions of not only retail investors, individual investors, but also institutional investors. Okay. Despite of the potential importance of the effect of social network and social interactions on the financial markets, exactly through what mechanism and how social interactions would affect the markets remains an open question. Okay, so there are sort of two competing mechanisms through which social interactions can affect markets. So on the one hand, the rational learning models suggest that when people interact with each other, they help disseminate valuable information that will potentially improve the efficiency of the market. Okay. On the other hand, there's also other papers that argue that while social interactions can also hurt market efficiency, because not only you are sharing information, but also you're also sharing noises, mistakes, errors, okay, that turn to amplify the irrational beliefs of naive traders or create free riding incentives so that, hey, if I know that my social network friends have already processed this information, then there's no incentive for me to spend the time and effort to gather information. And consequently, it may actually hurt the equilibrium efficiency, information efficiency of the financial market. Okay, so this is something that's highlighted by Hirschleifer's 2020 AFA presidential address. Basically, he argued that a crucial missing chapter in our understanding of finance is exactly the social processes that shapes economic thinking and behavior of agents. Okay, so and this question becomes even more important, especially given the proliferation of the online social media and the social network sites over time, right? So here I show two graphs. You can see that the number of Facebook active users worldwide has grown tremendously from about 10 years ago. Okay, and there's various popular social network sites that has also become extremely important that that affects people's lives on a daily basis. Okay, So this raises the important question regarding exactly what roles do social networks play in our social, political, and economic outcomes. And as a financial economist and as a regulator, what are the trade-offs are we potentially looking at, and what kind of policy should we be thinking about in order to promote the efficiency of the markets? Okay, so I have a few papers that's currently looking at the various dimensions of the effect of social networks. Okay, so here I just give you some quick flavor of what other dimensions we're looking at. In the first paper, joined with Teresa Kirchner, Yan Li, Johannes Strombo, and Dershing Zhou, we are looking at how does social ties between the institution and the location of the headquarters of a company, how does that affect institutions' investment decisions? Okay, and in equilibrium, how does it affect firm valuation and the liquidity of the company? Okay, in the second paper, it's joined with David Hirschleifer and Qiguang Wang. We're looking at how important news such as earnings announcements, right? That's one of the most important news announcements made by a company, right? So how does a social network affect the way investors become attentive to and respond to the earnings announcements made by companies located in various different nodes of the social network. Okay. In the third paper, joined with Turan and Hirschleifer and Yitang, we're looking at how social interactions affects investors' tendency to buy lottery stocks that turns to be small, have high volatility, have extreme, have the possibility of extreme one-day payoff. Okay, how does social interactions affect investors' demand for such stocks, and what does that tell us about investor behavior? And in the last two papers, we're looking at how does social network interact with crowdfunding sites. So in the fourth paper, joined with Linda Allen and Yu Shan, we're looking at how does social network affects both the supply and demand of the loans originated on the P2P fintech market. And in the last project, joined with Lin Yi Zhang, we're looking at how social network affects the crowdfunding of creative projects on Kickstarter, one of the largest reward-based crowdfunding sites. Okay, so obviously, given the short time span, I will not be able to tell you in detail what these papers are about. I will just talk more about the first paper to give you some more detail of what exactly is our economic question and what are the methods that we take to approach and address the questions. Okay, so in the first paper, what we're interested in is that there's, in the economists and the urban economists, they're always fascinated about why do certain areas have much better economic outcomes. For example, companies located in coastal cities or metropolitan areas, they tend to be more productive, more innovative, and they also enjoy a greater valuation. Okay, so there's been various explanations proposed. Some argue that, hey, maybe these places offer better amenities, they have better weather, better restaurants, greater entertainment opportunities that attracts highly skilled workers, and therefore the companies can also enjoy the benefit of these high skilled laborers. Okay, so what we do in this paper is we propose a complementary explanation. We argue that the geographic structure of social networks influences firms' access to institutional capital. Okay? So quick preview of the results. So what we do in this paper is that we use a novel data set from Facebook that allows us to identify the degree of connectedness between the regions across the United States. Okay, so therefore we can basically measure the social tie between an institutional investor and the company they're potentially interested in by the degree of social connectedness between the Facebook users in these two regions. Okay, using these social tie measure, we show that at the level of institutions, those institutional investors, they tend to invest more in companies from regions that are socially connected to the location of the fund. Okay, and more importantly, we show that the effect at individual institution level actually aggregate up and affect equilibrium asset market outcomes. We construct a measure at the firm level, which we call social proximity to capital. It essentially measures a company's the degree of the company's connectedness to the high AUM regions in the United States. And we find that for companies that has greater social proximity to capital, those companies have better valuation and enjoys better liquidity. Now, so why is this important? Well, so there's a huge literature that have previously shown that social networks matter. Using a specific set of individual market participants, their social networks, and they tend to only focus on the portfolio decisions of the institutions. Okay, our results are based on a much more comprehensive and representative measure of the social networks in the U.S. So therefore, it allows us to provide further insights into the role social networks play in the equilibrium of the capital markets. Okay, and we show quite convincingly that the effect of the social network are distinctly different from the geographic proximity-based networks that has been shown previously. Okay, so this suggests that the influence of social ties are different, and they are above and beyond what geographic proximity tie could affect investors' decisions. Okay, so now how do we measure social connectedness between an institution and a firm? Well, first I'm going to briefly talk about the Facebook data. Why Facebook? Well, Facebook is the world's largest online social network service site. It currently has 239 million active users in the US. So, you know, if you look at the adult US population, about 68% of the US adults are active users of the Facebook. Okay, so therefore it gives us a very representative and comprehensive measure of the social graph in the United States. Okay, in particular, the friendship links on the Facebook, basically we were able to obtain is this what's called social connectedness measure. Okay, it's a relative friendship probability measure constructed in Bailey et al. 2018 paper. So essentially, it takes the number of friendship links between county I and county J and scaled by the corresponding population in those two counties. So it captures the probability that an individual in county I will have friendship links with an individual in county J. Okay, so therefore we use that to capture the closeness of the social tie between the institution in county J with the firm in county I. Okay, so this is a graph of the social connectedness to Cook County in Illinois. So Cook County is where the city of Chicago is located. Okay, so as you can see, so the darker region basically represents a stronger social tie. So not surprisingly, you can see that next to the Chicago area, the area is turned to be very dark, right? This is consistent with social tie tends to be stronger the closer you are with the focal county. But more importantly, there are also a lot of other regions scattered around in the United States that's also quite dark, right? So for example, in the southern part of the United States, these counties also have a very high social tie with Cook County, consistent with the great migration that happened in the early 20th century when you have African American workers migrate along the Mississippi River to the northern area to look for industrial jobs. Okay, so the point of this graph is to show that you can see vividly from this graph that social connectedness is not the same as physical connectedness, right? So basically these faraway areas could have high social connectedness to the focal county. And also interestingly, you can see that you can have two areas that's right next to each other, but have completely different social connectedness to Cook County in Chicago. So again, this gives us a large cross-sectional variation that's going to help us with identification. Okay. So here is a map of the location of the institutional investors. The data we got is from Thomson Reuters 13F quarterly holdings. So we have about more than 3,000 fund families that's headquartered in the United States. So a third of them, less than a third of them is in the Tri-State area. About 12% of them are in California, but also there's substantial amount of institutional capital variation in the other regions of the United States as well. Okay, so our first key result looks at how institutions' portfolio decisions are determined by the degree of their social connectedness to the headquarters of to the city where the stock's headquarters is located at. So this is the percentage portfolio weight of institutional ICE portfolio invested in company J. Okay, so here the specification we employ is it's called it's a log-log. It's like log-log specification, and we estimated with Poisson pseudo maximum likelihood estimation methods. That's become a quite popular way to deal with the large left censoring problem that's used in the trade literature. And we also show that the OLS estimation also produced very similar results. Okay, so let's quickly get to the table. So here again, we're looking at how does social connectedness between the headquarters of the institution and the firm affect their portfolio decisions. Okay, so in the first regression, we have social connectedness as the key independent variable, and as you can see, is highly positive and significant. Okay, what does this coefficient mean in terms of economic magnitude? Well, note that here we have log-log specification. So essentially the coefficient can be interpreted as elasticity. So this shows you that if I increase the social connectedness between the firm and the institution by 10%, that's going to result in an increase of 1.89% increase in the weight of institution's portfolio invested in the firm. Okay, compared to the effect of geographic proximity, let's put them side by side. As you can see, geographic proximity by itself is negative and significant. It's to be expected because the shorter the distance, the more likely the institutions will invest because of the local bias. But once we put social connectedness and geographic distance together in the same regression, actually distance even flip the sign to become the wrong sign. So this suggests that perhaps the way that distance, it matters for institutional investment is indeed distance captures some element of social connectedness between the institution and the firms. Okay, but once we have a much better measure of the social connectedness, it completely absorbs the power of distance. Okay, and in the fourth column, we have a much more flexible way of controlling for distance. So rather than including distance as a standalone measure in a log linear way, here we throw in 500 different distance dummies to capture the potential nonlinearities in the effect of distance on portfolio investments, and the result remains highly significant. Okay, we further conduct panel regression analysis, and that allows us to introduce investor times firm fixed effect. So here we have a panel sample of companies that moved headquarter locations. Okay, so therefore that allows us to control for any fixed preferences for institution to invest in the company. Okay, so the panel analysis shows us that when a company moves from an area that has low social tie with the institution to an area that has high social ties, that significantly boosts the institution's weight on the stock. Okay, we explore heterogeneities of this result, but I think I will just not mention that. If you're interested, you can read the paper. I just want to get to some of the other results and give you some suggestions. Okay, so the second part of the paper, we move the analysis to the firm level, and we are looking at the aggregate equilibrium outcomes of such preference of the institution to invest in the firms. Okay, so we construct a social proximity to capital measure, which captures the firm's social tie to all the institution capitals in the United States. Okay, so it's the institution AUM for each county J weighted by firm's connectedness to County J, where the institution is located. Okay, so again, a lot of cross-sectional variations in companies' social proximity to capital, and what we find. So here we regress the outcome variables on the log social proximity to capital of the firm. Okay, controlling for a very rich set of fixed effects, country characteristics, as well as firm characteristics that has been shown to predict the outcome variables. Okay, so we show that when you increase the social proximity to capital of the firm by 1 standard deviation, it increases the equilibrium institutional ownership by 2.1%, increases the valuation in terms of book to market ratio by 12%, and it improves the liquidity by reducing the spread by 9.7%. Okay, the outcomes are larger for small firms and for firms with low analyst coverage. So basically ignored firms enjoying the most of the benefit from the social tie to institutions. Okay, so our results are consistent with firms with better, with higher social proximity to capital. They receive much higher investor recognition, which allows better risk sharing, reduces the cost of capital, and therefore increases the valuation. Okay, it's also consistent with the Shankman-Shaw model, where investors may have heterogeneous belief and short sell constraints. So therefore, you can, if a company can reach to a broader audience, then you get more investors with potentially heterogeneous belief, and therefore they are willing to pay a higher value for the company. Okay, we achieve identification with a shock to the social proximity to capital. Okay, using Hurricane Sandy, the second costliest hurricane in the United States history. So and the shock mostly affected the capital providers in the Mid-Atlantic states. Okay, so here we're going to look at firms in regions that are not directly impacted by Sandy. Okay, so we show that during the period of Sandy, so liquidity will decline for pretty much all the firms, even if they are not in the affected region. But what we find that's important is that for those firms that have higher social proximity to capital, if a lot of their social proximity to capital is contributed by the Mid-Atlantic institutions, then those firms suffered greater liquidity declines during the Sandy period. Okay, so the implication is that this helps with identification in the sense that, so the firms in the high social proximity to capital places that are not just special in the way that attracts either more liquidity provision from all investors on average. Instead, it is really the specific investors to which they are connected to that matters for their liquidity provision. Okay, so this is the conclusion from this paper. We show that institutional investors turn to overweight the socially connected firms. Okay, and in this social connection implied investor preference actually have important equilibrium outcomes in terms of liquidity and the valuation for the firm. Okay, so here I will just show one more slide what we find in my other papers. Okay, so in the paper that looks at how does social interaction affect investors' demand for the lottery stocks, we show that social interaction amplifies the effect of the non-standard preferences and behavioral bias, and therefore contribute to the amplification of the mispricing of such stocks. Okay. On the other hand, on the second paper, we look at how it affects market reactions to earnings. We show that social interactions have a dual role. Okay, so the positive role in the positive role, social interactions facilitates information dissemination and improves price efficiency in terms of incorporating earnings news. On the other hand, social interactions induces a behavior that's what we call stochastic investor disagreement. And that leads to excessive trading and persistent trading volume after the earnings announcement news. Okay, so in the third paper, we look at the P2P lending decisions, on both the supply side and the demand side of the P2P lending market. And we show that social interaction is beneficial, and in that it facilitates access to capital, allows better screening of the loans, and improves lending outcomes for the lenders. Okay, and in the last project, we look at how does social ties and peer effects affect crowdfunding markets. We show that both peer effects of this online social network, and the social ties between the founder of the project and the location of the project county, it encourages more funding, and it does affect real resource allocation outcomes in equilibrium. Okay, so basically, I think the one takeaway, if you will, from my talk is that I believe social economics and finance is a fascinating and exciting field for future research, and I hope you find that interesting, and I look forward to further discussions with you in the future. Okay, so now I'm going to use the last 3 minutes to give me my 2 cents on job market and career building. Okay, so for job market, so I know that most of you have already entered into the final stage of planning for the job market, and some of you are still in the earlier stage. So I think these are the things you want to keep in mind, right? So first, you want to identify your area, right? You want to think about how to best present your research package and the teaching package. More importantly, I think you want to have a vision, not just on what you are currently working on, but where you would like to be in 5 to 10 years. Okay, what areas you will be passionate about, and you would like to be associated with that area. Okay, you want to keep regular communications with your advisor and your committee members, constantly getting their feedback, right? So that will help you to be more efficient in your research activity and avoid a lot of the unnecessary detours, okay? And in the current job market, right? So I want to advise that you want to apply for a wide range of schools as much as possible, and you want to be flexible and keep the options open. So maybe it might be that this is a school that is currently have opening, but it may not be located in the area that you are excited about, or it may not be like your dream school. My suggestion is just to apply to those schools as much as possible, and then you can make a decision once you have an offer, but don't decline yourself the opportunity of being interviewed and possibly getting an offer at your school, because you may never know. If you had the opportunity to have a closer interaction with people, with the faculty members and students over there, it may change your mind. You may actually kind of like the school. Okay, so keep your option open. Now the next stage is conference interviews. Okay, so now that conferences will be all online, but I think some elements will still maintain the same. So basically, you want to prepare 2 versions of your spiel about your research. You want to have a short 2-minute version and a 10-minute version that's more detailed. Okay, so you want to start with a 2-minute version and see how your audience react to it, respond to it, right? So they may actually start to ask questions here and there. So you may never get to your 10-minute version. So it's good to have a 2-minute version so that you can quickly introduce yourself and your research area, what you have accomplished to your audience. Okay, in your 2-minute version and even in your 10-minute version, make sure that you focus on the big picture. Why is this important? Why is this interesting? Especially, why is this interesting to somebody who may not necessarily be in your field, right? What is your key contributions, right? How is it more exciting than the previous papers published in the literature? Okay, so try to avoid talk about technical details. Only mention those when there is a specific question about those technical details. Okay, and more importantly, you also want not only talk about your research, but also try to find a way to convey why your research interest and your teaching experience may matter and contribute to the schools that are potentially interested in you. Okay, so the next stage is campus visits, right? So now we don't know whether campus visits will be physical visits or virtual visits, but I think these are the things you want to pay attention to. First is you want to identify faculty members that may either share similar experience or similar research interests with you, right? And then, when you communicate with those faculty members, make sure that you find these kind of common ground. These are great ways to initiate and maintain further interest down the road. Okay, again, very importantly, in the campus visit stage, you want to make sure that you convey what could your contribution be for the schools that's trying to hire. Okay, And also, obviously, very important, you want to find out what's the research environment like and what are the teaching expectations in that school. Okay, now suppose you successfully graduate and successfully landed on your first job, right? What's going to happen beyond graduation? Well, first, congratulations, but your new career is just began, right? So you're back to square number one, right? So what are the things you want to keep in mind? You want to keep a good balance between research and teaching. I think there's been a lot of good advice from the morning sessions, okay? But I think my suggestion would also add to that is that first you want to find a good mentor in the organization, right? So each organization is different, the environment, the politics, the expectations could be very different. So you want to find a senior faculty member in the organization that you can seek advice on, that's your sort of your shortcut to quickly become aware of what's happening in the department. Okay, it's going to be especially important in the current pandemic period because now you don't have these kind of random encounters that's going to happen in the physical world. So you will be the one who need to reach out and identify the senior faculty members that could potentially be your mentors in their organization. Okay. And also very importantly, externally, you want to do the following things. First, you want to maintain good relationship with your former PhD advisors and committee members. So these people will be your lifelong resources in the profession, okay? And you also want to maintain an active presence in the field, go to the conferences, speak to people, right? Find opportunities to give seminars in various places. Okay, and also furthermore, I think that Alex also mentioned this in the beginning, right? You want to broaden your scope and try to identify smart people to work with and to learn from. Okay, in this highly competitive environment in the academics, in the finance academic area, right? Again, doing sort of solo single author work is going to take a lot of time and a lot of effort, and it just doesn't work as well when you can work with people that are, intelligent and to whom you will have skill complementarity. Okay, and finally, I understand that this year may not be a great year, right? So given the pandemic and the hiring conditions, but I want to give you some sort of a positive advice, which is your career is like a marathon. Okay, I don't know how many people here are runners, right? So I run a few half marathons. So the longer you are in this profession, the more you realize that, hey, it's really like a marathon. Okay, so you may have some headwinds at the starting line. Okay, but as long as you are persistent, as long as you are resourceful and skillful in getting those things that I mentioned, those headwinds at the start line will not have a material impact on the long-term success of your career. Okay, so I am very happy to see all of you, and I wish you all best of luck in the job market, in your PhD, and in your future career. And I look forward to getting to know more about your work, both this afternoon and in the future.